Across the world's most vibrant cities, the pulse of global finance beats relentlessly. Towering skyscrapers house institutions that move trillions of dollars each day, shaping the fate of nations and individuals alike. Stock tickers flash with numbers that can spark fortune or disaster in an instant. Behind closed doors, money is printed and traded at a scale that dwarfs the economies of entire countries. This is the unseen machinery driving prosperity, risk, and sometimes ruin. The sheer magnitude and complexity of these financial systems reveal a power that extends far beyond the trading floors, influencing every aspect of modern life. In this world, the stakes are high, and the consequences profound. Financial power extends far beyond the walls of banks and investment firms, silently influencing the foundations of entire economies. These institutions control the flow of capital, dictate lending practices, and steer investment decisions that determine which industries thrive and which falter. Their reach touches every aspect of daily life, from the interest rates on mortgages to the stability of jobs and the affordability of basic goods. As financial systems grow increasingly complex, their decisions ripple outward, shaping government policies and global trade. The concentration of financial power in a handful of institutions means that a single shift in strategy can impact millions, underscoring the profound influence these entities hold over both national prosperity and individual well-being. Global financial markets are experiencing a surge in volatility, as reported by the International Monetary Fund in April 2025. Tighter financial conditions, driven by rising interest rates and persistent inflation, have amplified risks across both advanced and emerging economies. Geopolitical uncertainties and unpredictable trade policies further destabilize the landscape, making investors wary and markets more reactive. These pressures are especially acute for countries with high debt levels, where refinancing and funding vital expenditures become increasingly challenging. The interconnectedness of financial institutions and sovereign debt means that shocks in one area can quickly ripple through the entire system. As volatility intensifies, the fragility of global economic stability becomes ever more apparent. Emerging markets and frontier economies stand at a precarious crossroads, burdened by rising debt and tightening global financial conditions. As international interest rates climb and capital becomes scarcer, these nations struggle to refinance existing obligations, often facing higher costs and limited access to funding. The International Monetary Fund warns that high debt levels leave these economies particularly exposed to sudden market shocks and shifts in investor sentiment. With public finances closely intertwined with domestic banking systems, even minor disruptions can quickly escalate into full-blown crises. Sustaining growth becomes an uphill battle, as governments are forced to divert resources from development projects to debt servicing. The result is a cycle of vulnerability, where economic progress is continually threatened by the looming specter of financial instability. At the heart of modern financial instability lies the sovereign debt nexus, the intricate web connecting government finances and domestic banking systems. When governments accumulate high levels of debt, their fortunes become tightly bound to those of major financial institutions. Highly leveraged banks, in turn, amplify risks by holding significant amounts of government bonds, making both sectors vulnerable to sudden market shocks. Animated infographics reveal how stress in one area can quickly cascade through the entire system, straining markets and threatening economic stability. This interconnectedness means that a crisis in public debt can rapidly undermine the foundations of the banking sector, and vice versa, creating a feedback loop that magnifies financial turmoil. In recent years, non-bank financial institutions, or NBFIs, have emerged as powerful players in global finance. Unlike traditional banks, these entities, such as hedge funds, private equity firms, and insurance companies, operate outside the conventional regulatory frameworks. As financial intermediation increasingly shifts toward NBFIs, liquidity risks have migrated from the banking sector into less transparent corners of the market. This transformation has heightened the potential for instability, as NBFIs often rely on short-term funding and can quickly withdraw from markets during periods of stress. The interconnectedness between NBFIs and other financial actors means that shocks can spread rapidly, amplifying volatility and undermining financial stability. Recent reports from the Bank for International Settlements warn that these risks are growing, making the financial system more vulnerable to sudden disruptions. Trade tensions have become a defining force in the global economy, sending ripples through markets and industries worldwide. Unpredictable policy announcements, often made with little warning, can trigger dramatic shifts in investor sentiment and market stability. These disruptions not only alter the flow of goods and capital, but also undermine confidence in long-term economic planning. As nations react to changing trade dynamics, businesses and consumers face heightened uncertainty, making it difficult to forecast growth or investment opportunities. The resulting volatility amplifies risks for both emerging and developed economies, exposing vulnerabilities in financial systems. In this environment, even minor policy changes can have outsized effects, reshaping the landscape of global commerce and deepening the sense of instability that pervades financial markets. Persistent inflation continues to challenge economies worldwide, with prices rising faster than central banks' targets. In response, institutions like the Federal Reserve have enacted a series of interest rate hikes throughout 2025, aiming to curb inflation and stabilize markets. These measures, while necessary to control price growth, have far-reaching consequences. Higher interest rates mean increased borrowing costs for both consumers and businesses, making mortgages, loans, and credit more expensive. As a result, household budgets tighten and companies may delay investments or hiring. The ripple effects extend to the broader economy, often slowing growth and amplifying financial stress, especially in sectors already vulnerable to volatility. This delicate balancing act underscores the complex relationship between monetary policy and everyday economic realities. Across global financial centers, stock markets have become a stage for relentless volatility. Sharp swings in major indices reflect deepening uncertainty as investors grapple with unpredictable shifts in economic growth and financial stability. The constant barrage of news, ranging from inflation data to geopolitical tensions, fuels anxiety, driving rapid sell-offs and frantic buying sprees. Behind the flickering screens and surging graphs, a sense of unease permeates trading floors and boardrooms alike. As debt levels climb and policy decisions remain uncertain, the fear of sudden downturns grows ever more palpable. This turbulence is not just numbers on a chart. It echoes through economies, affecting businesses, workers, and communities worldwide. Global public debt has reached levels never seen before in history. Animated charts reveal a relentless upward trajectory, with governments around the world borrowing at an accelerating pace. This surge in debt is not just a number, it represents future obligations that will shape the lives of generations to come. As debt piles up, the burden of repayment and interest threatens to limit public investment, strain social programs, and increase vulnerability to financial shocks. For many countries, the challenge is no longer just managing debt, but confronting the long-term consequences of decisions made today. The implications ripple outward, affecting everything from economic growth to the stability of entire societies. What we see on these charts is more than data. It is a warning of the legacy being left behind. Towering penthouses and lavish parties stand in stark contrast to crowded streets filled with protesters demanding change. While the finance industry fuels extravagant lifestyles for a select few, millions grapple with rising costs, stagnant wages, and uncertain futures. Economic downturns ripple through communities, leaving families struggling to afford basic necessities and businesses shuttered in their wake. The divide between wealth and hardship grows wider, exposing the consequences of unchecked greed and systemic inequality. Each financial crisis is more than a headline. It is a story of lost jobs, shattered dreams, and eroded trust. As luxury persists in the shadows of unrest, the true cost of financial excess is measured in human lives and the resilience of those left behind. Financial instability reaches far beyond the trading floors and boardrooms, impacting the daily lives of millions. As inflation persists and interest rates climb, the cost of essentials like food, housing, and energy continues to rise, straining household budgets. Many workers face uncertain futures, with job losses and reduced opportunities becoming more common as businesses struggle to adapt. The pressure of mounting debt and economic insecurity fuels anxiety, often leading to social unrest and protests in cities around the world. Ordinary families find themselves caught in the crossfire of decisions made by distant financial institutions, their futures shaped by forces beyond their control. In this environment, the gap between those who profit and those who bear the consequences grows ever wider.
Corruption within financial institutions and regulatory bodies erodes the foundations of trust that economies depend on. When oversight is weak or compromised, risky practices and unethical behavior often go unchecked, allowing systemic vulnerabilities to grow. Regulatory failures can lead to unchecked speculation, excessive risk-taking, and the concealment of mounting debts. As debt addiction intensifies, both governments and private entities become increasingly reliant on borrowing, pushing debt levels to unsustainable heights. This cycle not only amplifies the risk of economic collapse, but also undermines public confidence in the entire financial system. When trust is lost, markets become volatile, investment dries up, and ordinary people bear the brunt of the fallout. Leading global organizations have sounded the alarm on escalating financial risks. According to the International Monetary Fund, volatility in financial markets has surged, fueled by tighter monetary conditions and geopolitical uncertainty. The Bank for International Settlements highlights a shift in risk from traditional banks to non-bank financial institutions, increasing vulnerabilities in bond markets and liquidity. Central banks, including the Federal Reserve and the Reserve Bank of Australia, warn that persistent inflation and unpredictable policy shifts are amplifying instability. Recent data shows emerging economies with high debt levels are struggling to refinance, while advanced economies face mounting public debt. These expert assessments underscore the fragility of the current financial system and the potential for widespread economic disruption. Throughout history, financial crises have followed a familiar cycle, marked by waves of speculation, unchecked greed, and systemic mismanagement. Time and again, markets surge on optimism and risk-taking, only to collapse under the weight of excessive debt and flawed decision-making. Institutions chase short-term profits, often ignoring the long-term consequences for economies and ordinary people. As regulations loosen and oversight fades, vulnerabilities build until a sudden shock exposes the fragility of the system. The aftermath brings recession, unemployment, and hardship. Yet lessons are quickly forgotten as the cycle begins anew. This relentless pattern underscores how deeply ingrained behaviors within the finance industry continue to shape and sometimes devastate global economies. As the dust settles over shattered skylines and fading cityscapes, the true cost of unchecked financial ambition becomes painfully clear. Behind every collapsed building and every silent street lies a story of lost livelihoods and broken promises. The relentless pursuit of profit has left entire economies vulnerable, exposing the fragile foundations on which they were built. While ordinary people bear the brunt of financial turmoil, a select few continue to thrive amid the chaos. In the shadows of crisis, the question echoes louder than ever: who really profits?